In this presentation, we will record a home loan into our personal QuickBooks file and create an amortization table we can use to record payments properly in the future. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are on the home page. We currently have the open windows open. We can open the open windows by going to the view drop down and selecting the open windows list. We're now going to open up the balance sheet by going to the reports drop down and going down to the company and financial and then to the balance sheet standard. Within the balance sheet standard, we're going to change the customize report option up top to 01/01/20 to 12/31/20, the year we are working on, January through December 2020. While here, we'll change the fonts and numbers. Fonts and numbers tab, change the font. 11 will be the change we'll have, and then we'll say okay, yes, and okay. All right, this is what we have so far. We've entered into this format the home, and we have the home on the books, but not the liability. We're going to enter the liability, the loan, on the books as well, but our problem this time, which we'll treat a bit differently, is that we want to make sure that we record the payments correctly. In order to see that, we're going to look at the profit and loss. So we'll go to the reports drop-down, company and financial profit and loss standard, changing the dates from 01/01/20 to 12/31/20. I'm going to change the font size, customizing the report, fonts and numbers, change font, 11, okay, yes, and okay. Okay, if we scroll down here, we can see that we made payments because this is what's going to come out of the checking account. So we made payments and we recorded them as an expense. So these two payments are on the loan. It's nice to see them as an expense, but it's not proper under an accrual basis. We should only expense the interest portion and bringing down the loan. So our goal then is to record the loan as of the current point in time onto our personal books, and then to create a method so that we can then allocate the payments correctly. We'll go back into these payments and allocate them correctly in accordance with the interest versus the principal portion of the loan payments. To do that, we're going to need an amortization table. So we'll go to the amortization table. It's going to look like this. This is the end result. This is our cost. This is the loan that we originally had. So this is our original loan. The terms of the loan are going to be 30 years or 360 monthly payments. Interest rate and the payments are $2,300. That $2,300 then is what we see on the QuickBooks files. We go to QuickBooks. We double click on the mortgage, $2,300 is what we are paying. So if we go back to our file, then we need to be able to break those payments out between interest and principal. That's going to be our goal. When we first enter this on the books, we're probably just going to enter it from the bank, from the loan statement. So we don't need to enter it this time. We won't enter it just as the loan balance, but at the balance of the prior statement. And whatever the prior statement says, we're going to say that we're on this payment, the 112. So we're going to say that they're just telling us to pay this 326,471. That's the loan balance as of the point in time we put it on the books. But in order to create this table, typically we have to do the whole thing. They don't give it to us a lot of times. So we're going to create this amortization table so we can see this breakout and why it's kind of an issue, and then record the loan balance, and then we'll be able to enter the data. Now this is a very intimidating looking table. It's not too bad, so we'll get an idea of why it's important. So let's take a look at that. Here's the basic table that's not filled out, and this is usually what we know on the loan. We know the loan amount, we know the years, 30-year loan, 360 payment, 30 times 12. The interest rate, we're going to say 6%, and we know the payments. We know what we're going to pay each month. What we don't know is how to break out this payment between interest and principal each month, and the problem is it's not the same from time period to time period. We'd have to do an amortization table to do it properly. So that's why, so that's the pros and cons of it. So what we'll do then is create this amortization table. Now, we have to create the amortization table from the beginning of the loan, even though we're saying we're way down here in payment number 112. So we'll get to that payment 112, but we're going to enter it as of the payment 1, because that's how you just make the table. So what we're going to have is the payments, the interest, the reduction in principal, and the principal. We'll start off with the loan amount, the principal of the loan. I'm going to do this with a formula by saying equals and point to that loan amount, 383,621. There's our principal. Then the payments that we make are always going to be equal to this 2,300. What I want to do, I'm going to hit enter. I'm going to do some copying down. We're not going to do this 360 times. We're going to copy this down. So just note, I'm going to use the autofill later, which is clicking on this cell and putting our cursor on that little box and then autofilling it down. And I'm just going to do it now to show us if I do that, it doesn't do what I wanted. I want to bring this payment all the way down. It's going to be the same payment each time. If I double click on it, I see that what it did is it pulled down relatively to the next cell. So I want to stop it from doing that so I can just copy it all the way down without it, going down a cell. So I'm going to delete this, go back on this account, double click on it, and on the keyboard I'm going to select F4, which just puts a $sign before the 4, before the B, and before the 7. Or you can just put a $sign before the B and before the 7. And then what that tells, it has nothing to do with money. It just tells QuickBooks don't move that cell. So we'll say enter. And then when I put my cursor on it and drag it down, it stays the same. So just beware of that. That's what we want to do first. Interest is going to be calculated in this format. We're going to say that we have the principal amount, 383,621, this amount here, times the interest, 6%, which is 0.06, 6%, 0.06. That would be for a year though, so we have to divide it by 12. Divided by 12, that's our monthly interest. So I'm going to do that with formulas here. I'm going to say this equals this amount times the 6% divided by 12. I'll just hard code the 12. So we're taking this divided by that times 12. And enter. The reduction of principal, if this is what we're paying, and this is the interest portion, the reduction of the principal is the difference between the two, or equals the 2,300 minus the interest portion, the 1,918. The principal should then go down by 382. Then I'm going to take the principal, what it was before, minus the reduction in principal. That'll be equal to this number minus this number, and enter. What I want to do now is try to copy this down. I'm going to select this whole cell and then take this autofill and copy it down and see if it does what we want. I'm going to copy it down, and notice something went really funny here. Something happened. If I double click on it, I could say what I would like to happen, interest, I'd like to take the principal, the new principal, that's correct, it went down, times interest. The interest moved down, kind of like we saw over here, and I don't want it. I want it to pick up that interest rate. So what I'm going to do is say enter and then undo and see if I can fix this cell to allow it to be pulled down without messing things up. So we'll double click on it, and this cell, which is B6, I want to absolute reference it just as we did over here by saying F4, $sign before the B, $sign before the 6. That's going to be our formula or absolute reference code for QuickBooks, and then enter. And now let's select those 4 numbers again, let go, put our cursor on that field and drag it down, autofill, and see if it does what we want. This should be the same. Payments are always going to be the same. Interest is slightly different because now we're taking the new principal, which is now slightly different, times 6% divided by 12. That's the issue. That's the problem. That's why we have to do this. And then enter. And that means the principal reduction will differ because it's now the payment's the same, but the interest went down, so the principal went up. And now the principal went down by this reduction amount. So that's the essence of it. So you can kind of see how that works, but we need some type of amortization table because you can see that although the payment's the same, the allocation between interest and principal is different. So we need to know what this allocation is if we're going to properly record this kind of loan. So it's an installment loan. So we're going to highlight this. We're going to select this item and then just do this all the way down. I'm just going to put my cursor on autofill all the way down to 130 payments. And that, once we get all the way down here, the last payment should turn to 0. This number right here, once I let go, should be 0. So I'm going to let go, and that makes it 0. So now we can see that it's got to be right. Now look at this last payment. Same payment amount. Interest is only $11. All the rest is principal. And you can see the interest portion going up and the principal portion going down all the way up, right? Even though the payment is the same. So it's radically different on the interest versus principal, although the payment is the same as the loan goes down. So if we go back up here, then that's what we need to adjust. So now we can use this table to record the interest and principal. What we'll do next time is we'll go into QuickBooks and we'll record the balance as of the time period that we started entering data into the system. And then we'll adjust these payments not to be expensing the full payment, but to be breaking out between interest and principal in the proper way. And then we'll have the proper interest recorded here, and the loan will be properly recorded on the balance sheet. For more accounting information and accounting courses, visit our website at accountinginstruction.info.